Taxation in South Africa may involve payments to a minimum of two different levels of government, central government through the South African Revenue Service or to local government. Central government revenues come primarily from income tax, value-added tax, corporation tax and fuel duty. Local government revenues come primarily from grants from central government funds and municipal rates. In the 2012/2013 fiscal year, SARS collected $813.8 billion in tax revenue, a figure $71.2 billion more than that from the previous fiscal year. Indiana, 2012/13 financial year. South Africa had a tax-to-GDP ratio of 25.3%, reflecting a marginal increase from 25% in 2011 December. Overview of the $813.8 billion collected by SARS in 2012/2013, $459.6 billion came from direct taxes and $353.3 billion from indirect taxes. The cost of collecting tax revenue has remained somewhat constant, decreasing slightly from 1.11% of total revenue in 2011 December to 1.07% in 2012/13. In the 2010 November financial year, SARS collected a total of $674.2 billion. Direct taxation. Direct taxes are taxes which are imposed on individuals, trusts, deceased estates, companies and close corporations, all of whom are otherwise known as persons. Income tax. South Africa has a progressive income taxation system which is based on the premise that the wealthy should contribute a greater proportion towards supporting the state than the poor. This means that the more a person earns, the higher percentage tax they pay. By law, all employers have to register all employees as taxpayers regardless of their tax liability. Income tax in South Africa was first introduced in 1914 with the introduction of the Income Tax Act No. 28, an act that had its origins in the New South Wales Act of 1895. The act has gone through numerous amendments, with the act presently in force as the Income Tax Act No. 58 of 1962, which contains provisions for 4 different types of income tax. These 4 types of tax are: normal tax, donations tax, secondary tax on companies, withholding tax. Normal tax. Normal tax in South Africa is a levy imposed on all persons in the form of an annual tax that is calculated by applying predetermined rates to a person's taxable income. This type of income tax can be divided into individual income tax and company income tax. Individual income tax. Individual income tax rates in South Africa range from 18% to 40%. Although the tax threshold of $63,556 means that anyone earning less than this amount pays no income tax. Individuals earning less than $63,556, 2013, a year do not need to declare their income and do not need to submit an income tax return so long as their remuneration is from a single employer. Their remuneration is for the full tax year and no allowance was paid, from which PAYE was not deducted in full with regards to travel allowance. Indiana, 2012/13. There were a total of 13.7 million registered individual taxpayers. There were a total of 5.1 million assessed taxpayers in 2012/13 with total taxable income of $1 trillion, of that they were liable to pay $206.7 billion. 40.1% of assessed taxpayers were registered in Gauteng province and 27.3% of them employed in finance, insurance, real estate, or the business service sector. 27.5% of them were aged 35 to 44 and 5.7% or 289,476 declared a business income. The 2012 tax year saw an increase in the threshold for the top personal income tax bracket to $580,000. Other increases in tax thresholds include $59,750 for people below the age of 65, $93,150 for people aged between 65 to 75, $104,261 for people aged 75 and above. In 2009 there were 3.5 million assessed taxpayers with a total taxable income of $632.6 billion, of that they were liable to pay $154.1 billion. Of them 28.8% were between 35 to 44 years old and 56.7% were male. 3.9% of them had business income. Over 60% of taxable income came from salaries, wages and remuneration. Travel allowances were the largest allowance claim. The largest fringe benefit was medical aid paid on behalf of employees, and contributions to retirement funds were the largest tax deductions. Although the number of taxpayers has increased, most taxpayers fall below the R63,556, 2013, taxable income threshold and so are not required to submit an income tax return and are therefore not included in the 3.5 million assessed taxpayers. Old Mutual Income Tax Calculator, SAIT Income Tax Calculator. Company income tax equals. The company income tax rate is levied at 26.67%, according to the Company Law No. 71 of 2008, of the taxable income of the company. Certain companies qualifying as a small business corporation where tax is levied at 10% for taxable income above $59,750 up to a limit of $300,000 and 28% on taxable income above $300,000. Employment companies pay a tax of 33%. Dividends were subject to an additional tax called the secondary tax on companies, which was 10% of declared dividends. This tax was replaced by dividend tax on April 1, 2012. However, secondary tax on companies' credits can be used until March 31, 2015. In the 2009 tax year, 34.2% of 473,034 companies in South Africa had taxable income. Of them, 56.5% of the tax was paid by 222 large companies with a taxable income in excess of $200 million. Around 50% of the collectively assessed companies were from the finance, retail and wholesale trade sectors and were responsible for over 35% of this tax. The mining and quarrying sector, consisting of only 0.3% of the companies assessed, shrunk from 8.6% in 2006 to 5.7% in 2008, reflecting the declining importance of the mining sector to the South African economy. Donations tax. Tax on donations is linked to estate duty, which was first introduced in South Africa in 1955. It is not a tax on income but rather on the transfer of wealth, but differs from estate duty in that it specifically taxes gifts and donations as opposed to inheritance. This tax subjects certain donations made by persons to a flat rate of 20%. Dividends tax. Dividends tax is a policy tax imposed by government with the aim of encouraging companies to retain profits instead of giving out dividends. It takes the form of a 15% tax on receipt of dividends given by companies and closed corporations. Some of the recent growth in this tax revenue for 2012/13 occurred due to increases in the value of taxable economic activities and higher compliance rates, even though this tax rate remained the same. Prior to April 1, 2012, this tax was known as the secondary tax on companies and took the form of a 10% tax on the net dividend distributed by companies and closed corporations. Withholding tax. Withholding tax, also called retention tax, is a government requirement for a South African payer of an item of income to a non-resident in South Africa to withhold or deduct tax from the payment, and pay that tax to the government. This tax can be divided into two categories: A. Withholding tax on royalties of 12% unless double taxation agreements apply. A withholding tax on payments for fixed property, which applies to any person who must pay a non-resident for a movable property in South Africa. This tax ranges between 5% to 10%. Estate duty. Estate duty is similar to donations tax in that it is a tax on the transfer of wealth. The duty is charged on the death of a person and is based on the value of the deceased's estate at the date of their death. It is 20% on the amount remaining in the deceased's estate over $3.5 million. Capital gains tax. First introduced on October 1, 2001, capital gains tax is effectively charged by adding a percentage of the increase in value of an asset, that was disposed of for more than its base cost, to the taxpayer's taxable income. For individuals, deceased estates and special trusts, 33.3% of the net gain is added to their taxable income. For companies, close corporations and trusts, 66.6% is added. Net capital losses in any given year cannot be used as a set-off against ordinary income, but can be carried forward to the following years to be used as a set-off against future capital gains. Indirect taxation. Indirect taxes are taxes which are levied on transactions rather than on persons. Value-added tax value-added tax is a broad tax made by vendors on the supply of goods and services that is charged upon purchase. VAT must be paid irrespective of whether or not it is a capital good or trading stock so long as the vendor uses the goods in his/her enterprise. It's compulsory for a business to register VAT remission when the value of taxable supplies in a 12-month period exceeds or is expected to exceed $1 million. Value-added tax was first introduced in South Africa in September 29, 1991 at a rate of 10%. Currently VAT is set at 14%. If given price on an item charged by a vendor does not mention VAT, then that price is deemed to include VAT. South Africa VAT Calculator, Indiana, 2009/10 fiscal year. About 72% of the 685,523 registered VAT vendors were active. Over 55% of VAT vendors had a turnover of less than $1 million. People who are not South African passport holders and are not resident in South Africa are eligible to claim back VAT on movable goods purchased in the country provided they present a tax invoice for those goods. Fuel levy. The fuel levy in South Africa represents a tax paid at the pump on fuel, predominantly processed fossils fuels like petrol and diesel. In 2011 this tax represented about 29.6% of the price of 93-octane petrol and 30.3% of the price of diesel. 5% of the total fuel price paid at the pump in South Africa goes to the Road Accident Fund, which is a state insurer that provides insurance cover to all drivers of motor vehicles in South Africa in respect of liability incurred or damage caused as a result of a traffic collision. 100 years of income tax in South Africa. During 1914, General Jan Smuts, in his capacity as Minister of Finance, tabled legislation in the Parliament of the Union of South Africa introducing income tax in the country with the Income Tax Act of 1914. Taxpayers in the Union of South Africa became liable to pay income tax with effect from July 20, 1914. In 2014, 20 years since South Africa became a constitutional democracy, the University of Cape Town marked this milestone since the introduction of income tax in South Africa with the Income Tax in South Africa, the first 100 years 1914 a Euro 2014 conference. References